Quote, "How many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case." End quote, by Robert G. Allen. Investing is the #1 strategy for building long-term wealth. Successful investing enables you to increase your investable assets over time and realize your financial goals, such as home ownership, financial freedom, or even retirement. Your investable assets may grow in value and outpace inflation if you make successful investment decisions. Investing in a savings account is a sure and safe thing, but because the interest rates are so low, your profits will be tiny, unlike investing in the stock market. But investing is not as easy as some portray, nor is it as difficult as you would think. That's why in today's video, we will be highlighting 10 mistakes every investor makes. First off, we have number 1, having a short-term focus. Investing with a short-term focus often entails buying and selling assets in a very short amount of time to turn a quick profit. While this strategy may sound alluring, it can also be dangerous because short-term market movements can be inconsistent and result in substantial losses. Over a longer period, historical returns have tended to reward patient investors. If you want to be a successful investor long-term, then it is vital to have a long-term perspective while investing and avoid getting caught in short-term fluctuations in markets, since investors who only concentrate on short-term gains may miss out on wealth from long-term growth. Stock market returns may fluctuate widely over a shorter period. As of May 2023, the S&P 500 has generated an average yearly return of 11.51% over 10 years. Its return from 2022 is more than -20%. Stock market returns can fluctuate widely over shorter periods. Number 2, buying high, selling low. The term buying high and selling low refers to purchasing a stock when its price is at or close to its peak, and then selling it once its price has drastically declined. The goal of successful investing is to purchase investments low and sell high, or realize income and cash flow from dividends. Based on the S&P 500 in 2000, it can be shown that at the height of the stock market before the 2000 crash, investors poured cash into stocks and withdrew it from low-risk bonds. The market lost value over the ensuing 2 years by -11.89% and -22.10%, which was a loss to investors because they were buying high. Investors withdrew their cash from equities in 2002 once the market crash was over and put them into low-risk bond funds instead. Over the following 2 years, the market rose for gains of 28.68% and then plus 10.88%. Investors, however, lost out because they sold low. Similar to this, after the 2008 market meltdown, investors flocked to bonds rather than stocks. The following year, the market increased by 26.47%. Number 3, trying to time the market. A strategy known as market timing is buying and selling stocks based on expectations of potential future market movements. While trying to time the market to maximize gains can be alluring, it is typically not a successful course of action for the average investor because doing so could ruin investment returns, and correctly timing the market is nearly impossible. Even institutional investors are most often not able to do this. Number 4, risk. Risk is not based on market volatility, and the risk of an investment is not determined by past volatility. It can be risky to participate in some kinds of businesses simply because of the economics of the business, since risk originates from the nature of various types of businesses. But successful long-term investors usually maintain a low level of risk to minimize losses. Lower risk equals greater stability. A low-risk investment ensures the preservation of the initial investment capital. A low-risk investment goal is often to yield a return that is equal to or slightly higher than inflation over time. A high-risk investment, on the other hand, has the potential to make enormous gains or lose a lot. Number 5, allowing emotions to influence your choice of investments. One of the biggest killers of investment return is emotion. Although it is common for people to experience emotional responses to stock market investments, successful long-term investors do not base their investment decisions on feelings. Investment decisions should be based on thorough studies of the potential risks and upside of the venture and within your circle of competence, and not based on your irrational or emotional reactions. Number 6, not diversifying your portfolio. Diversification is a protection against ignorance. Investment portfolios shouldn't be too heavily weighted toward any one business or market segment. Investment risk can be reduced by making investments in a variety of industries and through a variety of investment vehicles, including stocks, bonds, and treasury bills. While it is sensible, to diversify too much of something can become counterproductive. Diversifying your portfolio too much can end up leading you to be unable to make swift and smart decisions because your attention is spread too thin. That's why it's wise to consider businesses that you have a level of familiarity with. A successful long-term investor invests in businesses within his circle of competence and always has a sense for the pricing of his investment. Number 7. A stable personality. Successful investing requires a temperament that doesn't take pleasure from being with or supporting the crowd, as investing is a thinking-intensive business. According to Ben Graham, you're not right or wrong because 1,000 people agree or disagree with you. You are right because your reasoning is correct. Number 8. Market condition. Although the state of the market is very important when it comes to investing, it's not in any way the most important factor. A lot of newbies and even seasoned investors tend to use market conditions to determine how they will invest. This is not a terrible idea, but it causes a lot of people to freeze up when it comes to making quick decisions. No one can or will be able to truly predict the market, so that's why anyone looking to become a successful long-term investor should invest in good businesses, not markets. Number 9. Being greedy. It can be fruitful to take risks, but there is a difference between reasonable and calculated risk and greed. A lot of investing masterclasses may tell you that being greedy is the only way to make it as an investor. That has been the kind of thinking that has backfired on a lot of newbies. It's considered a myth that the most successful people made it to where they are because they were greedy, their ego, and they wanted more. To seek further progress and development is a logical thing to do, but when greed gets mixed in, it can blind investors into ignoring the signs of a bad business or bad investments. By the time they realize they have made bad decisions, they can sink into the sunk cost fallacy, causing the investment to go to waste. Successful people have the temperament to identify a good business and not give in to greed to make risky investments. Both Charlie Munger and Warren Buffett say they far prefer to have a great business at a fair price as opposed to a fair business at a great price. Number 10. Abandoning a good strategy too quickly. Don't wait for a correction. When investing, successful long-term investors have been found to take a hard and soft approach. This simply means to be flexible in your mind, but also be rigid when it comes to strategies that work. It's safer for you to endure losses on a good strategy that has worked for you before than for you to jump from one strategy to another. As much as non-professional investors like to compare both of them, investing is not betting, and it is also not gambling. There you have it. These are some of the most common 10 mistakes investors make. Thank you for watching. If you like our cutting-edge investment content curated by professionals with decades of entrepreneurial and investing experience, remember to like the video, subscribe to our channel, and join in on our alerts so you never miss our new content. Oh, and check out our other popular video on this screen.